All right. Good morning, everyone. My name is Mike Mills, and I represent the legacy team here at Equity Concepts. On behalf of our team, thank you all very much for joining us today, and Happy New Year to everyone as well. It is our honor to really be joined today by Bryce Gill from First Trust Investments. Bryce is an economist at First Trust, and First Trust has been ranked by Bloomberg as one of the top forecasters of the U.S. economy. Bryce, thank you very much for joining us today. I know you have some prepared comments to go over with us, and a number of questions have already been submitted as well. And I know Bryce is going to kind of touch on those questions throughout, and then any we don't get to will be answered at the end as well. And just as a reminder, we have a Q&A button there. So if you have a question that maybe is not getting answered or touched on, feel free to submit that Q&A through the Q&A button there as well. So let's get started. We're coming off really a very interesting year in 2022 from a war in Ukraine that started earlier in the year, the highest inflation in 40 years, a very difficult year for public stocks and bonds, and a 60% equity portfolio, 40% bond portfolio that had its worst year since 1937. So that's all the good news, right? Just kidding. That's all behind us. Last year definitely proved that being positioned properly across different asset classes, both public markets, private markets, and protection is key to a well-rounded portfolio. So with that behind us, what does First Trust think, Bryce?
Yeah, well, hey, the honor's all mine, Mike. Thank you so much for having me. It's great to be with you this morning. And yeah, I mean, we obviously 2022 was a really challenging year. And you mentioned since like the 1930s, it's the only calendar year I could find that stocks and bonds both went down over 10% in the same year. So really tough. There's nowhere to hide. And it was all about this inflation situation. You know, we've been kind of warning about this since the middle of 2020, but the market finally kind of woke up to the reality that this wasn't transitory. It wasn't just Ukraine. It wasn't, going to go away overnight. And what we saw was, hey, the Federal Reserve started hiking interest rates, probably at the fastest pace since like the Paul Volcker days. And this had huge implications for the market. And there really was nowhere to hide, except for maybe the energy sector, right? Oil and gas, or, the private markets. There were some areas there as well. But as we head into 2023, I think the good news is, I think the worst of the inflation's behind us. We have seen that rate of inflation begin to moderate. I think expect some better news on that front. Probably have seen, the lion's share of the interest rate hikes that are going to occur. And, we're not going to go back to like a 2% 10-year treasury yield or anything like that. But, I don't think we're going to see interest rates double again or anything along those lines. That being said, though, I do think we probably have a recession on the horizon here in 2023 that we still have to deal with as well. And so, volatility, which has been the name of the game in the public markets, I think that's here to stay in 2023. It's going to be, another challenging year that we just got to kind of muddle our way through. And the bottom line is, we're just basically reaping what we sowed during the COVID pandemic with regards to the measures that we took. And so I'm going to kind of go through that side of things with inflation and interest rates and the COVID stimulus and the impacts that had, and just give some opinions on, hey, why we're worried about, a recession in 2023. And then, we'll just open it up. We'll do some Q&A. We've got a list of questions from the viewers. So anything that I don't cover in the presentation, we'll make sure to circle back on. And yeah, everybody watching, if something's been on your mind and you want me to try and address it, no guarantees, right? But I'm happy to do my best. So go ahead and type that in the chat box, and we'll make sure to try and address your concerns as well. So with that, Mike, let me go ahead and pull up some slides and let's get into it. Let's talk a little bit about what's been going on and why we are experiencing inflation at a 40-year high. And so, at least in my opinion, okay. Sorry about that, guys. What in the world? I think the inflation situation has been massively overcomplicated over the past few years, okay? And to people kind of muddying the waters or trying to make it more complicated than it has to be, inflation is too much money chasing too few goods. And when you think about what happened during this COVID pandemic and the government response to it, we blew both sides of that old saying, right? We printed a whole bunch of money up and we shut down the entire global production system. And so, hey, less goods, more dollars chasing those goods, that's a recipe for a 40-year high in inflation. That's how we've gotten to where we're at today. Okay. And so the first thing I want to talk about is just the too much money side of the problem, because, yeah, let's start out with the good news, right? And there is actually, if you can believe it, a substantial amount of good news about the U.S. economy, especially compared to what we dealt with in the 1970s. And so let's start out with the too much money side of the problem. And the chart I have on the screen here, this is called the M2 money supply, and I just charted the growth rate over the past, what is it, like 60 plus years, okay? And, why do we care about the M2 money supply? Why should anybody care about this? This is what we call high-powered money in economics, or think about it as like dollars in people's hands, right? Checking account balances, savings account balances. If we print a whole bunch of money up and I just like buried it in the ground, it couldn't really affect prices, okay? And by the way, this is kind of crucially what a lot of people got wrong when they called for hyperinflation after 08, 09, the financial crisis. The Fed was printing a lot of money, no question about it, for quantitative easing and things like that, but it never really made it into people's hands. We used it for Dodd-Frank capital ratios, or it got stored away in excess reserves. And so if you look at M2 during that period, nothing notable really occurs. You compare that with 2020 and 2021, totally different story, right? We print up $5 trillion, which, by the way, those numbers get so big they lose context. That's what we spent on all of World War II in inflation-adjusted terms. So we're talking about a huge amount of money, and we just sent checks to everybody in the country, right? And so you can clearly see what happened on this chart. We saw the fastest growth rate in the money supply in modern U.S. history. This has been a huge tailwind for inflation. People just have way more dollars to go out and spend, okay? And, I would argue this has helped drive a lot of the inflation that we've seen over the past couple of years. But the good news is, obviously there's negatives from the Fed hiking rates and tightening monetary policy, right? If you own financial assets, you've been kind of taking it on the chin. But at the same time, the growth rate of the money supply is rapidly falling back to normal. We stopped printing money to send checks to everybody. The monetary inflation tailwind from just more money being in the system is starting to go away pretty quickly. And so that's why you're beginning to see inflation peak. You're starting to see progress happen there. It's this component. It's the too much money side of the problem that's really helping us out here to see some progress. And so that means, hey, the Fed's not going to keep hiking at the pace it's been hiking. It means, the markets are going to, find their bottom with regards to, interest rates are just not going to keep going up and up and up. And so this is kind of one piece of optimism here, is we are making some progress on the problem, okay? Now, that being said, the number that's in like everybody's head in the finance industry is 2% inflation. That's the Fed's target. That's been sort of the status quo for inflation for a really long time. I think it's going to be really, really hard to get back to 2% inflation here in the next few years. I'll talk about why on one of my next slides. But before I get into kind of, I guess, the challenge or like the negative side of the inflation, I do want to point out one other big positive for the United States right now. It's something that, frankly, I don't hear this get covered at all in like mainstream press or anything like that. Most of the news on like the energy sector in the U.S. is Joe Biden's shutting down Keystone XL, or they're not approving oil and gas leases, and all of that is true, no question about it. The federal government is not helping out here, but the picture for energy has really changed for the United States over the past decade in a very positive way. And I like to say energy independence for the United States has kind of made a comeback, okay? And so what I've got on the screen here, I've just added up the exports of U.S. energy, and I just subtract out the imports, okay? And so the whole idea on this chart is, hey, if we're reliant on foreign producers for our energy, we're net importers of energy, somebody's got a lot of leverage over us, right? And by the way, energy is always an important component to inflation. When we think about the 1970s, what do people think of? They think of like gas lines, they think of the Arab oil embargoes, things like that. And hey, if you look at the chart here, the U.S. is a net importer of energy during the 1970s, okay? And this was the case up until about 2014. We were net importers of energy for that entire period. When something fundamentally changes, which is hydraulic fracturing technology gets implemented all over the United States, and we rapidly start producing more oil and gas than pretty much anybody else in the world, very quickly we become net exporters of energy. So today, there isn't anybody with a huge amount of leverage over us with regards to the energy sector. And energy is really important because energy is a unique good. It goes into every good and service in the economy. I'd say like energy supply, food, and clean water are like the pillars of modern civilization. The United States is not as at risk as we were in the 1970s when we were relying on imports. Okay. And so really it's not us that's having an energy crisis. It's the Europeans, right? They became reliant on Russia for imports of energy. And obviously that's been a big component of all the, the trouble going on over there. So I think what this does right here, guys, is it just puts a ceiling on the inflation rate. It kind of gives us a margin of safety that we didn't have back in the 1970s. It's the reason why the U.S. inflation rate is just lower than pretty much all over Europe right now. So that being said, all right, let's talk about the challenge here with the inflation situation. And this is, I guess you call this like the too few goods side of the problem. And really, in my opinion, this is like the legacy of lockdowns, COVID shutdowns, okay? Which we've never did anything like that in all of human history, right? In the way that we did. And even if we had done it in the past, it wouldn't have had as big of an impact because the world wasn't as integrated through globalization as it was during the COVID pandemic, okay? And so what I've got on the screen here, I call this globalization in one line. I've just, added up imports and exports, adjusted all this data. A way to think about this line is it's how many goods are actually crossing the U.S. border. This data goes back to 1913, so we have a huge amount of time we can look at. And what you see is ever since like the Great Depression, when globalization bottoms after Smoot-Hawley and all the other things going on back then, globalization's been on the rise for the United States. And there's obviously negatives to this, right? Your supply chains, everything goes abroad. Well, you're at risk when the whole world goes into chaos. But the positive side of globalization is that it makes things cheap, right? So I think it has really big implications for the inflation question. And if you think about it, for about 90 years, it's been this consistent deflationary force, keeping a lid on consumer products for the United States. So we've been big beneficiaries of globalization, at least from a consumer perspective, right? There's obviously winners and losers. And, the negative is the supply chain problems. But, okay, globalization kind of hits a peak after 08, 09. It's been plateaued for about a decade. So that by itself, that's kind of interesting. It's pretty concerning. But when you think about COVID shutdowns, supply chains being thrown into disarray, now this war in Ukraine with Russia getting removed from the world markets, I think we're going to see globalization decline to some extent. And strategically, it makes sense, right? We got to start producing some of these things for ourselves, or at least bring supply chains closer to home. So there's a positive side to this, which is the United States becomes more self-sufficient. And we've seen a lot of movement on this, specifically with like semiconductors, right? We're worried about Taiwan being invaded. So they're building semiconductor plants all over the US at breakneck speed. The bottom line is, though, hey, it's going to be more expensive to produce some of this stuff in the United States than it was to produce it abroad. That 2% inflation number that's been in everybody's heads for forever, that's highly reliant on globalization continuing to go up and up and up. I think globalization really is like a cornerstone of that status quo. I just don't think that's so reliable anymore. So deglobalization or like reshoring would be the positive way to frame it, right? I think that's going to be a big challenge in getting back to that 2% inflation number. And this is something that's going to take, years to figure out. So expect more progress on the inflation front, but, I don't think we're going to be back to 2% by the end of 2023, which is, by the way, that's the Federal Reserve's official forecast. I think they're looking for like 2.2% inflation or something. I just don't see any way that ends up working out. So with that said, guys, let's just talk really quick about why we're concerned about a recession in 2023. And as a country, the United States, we just went through this huge debate in 2022 about whether or not we were having a recession, right? We had 2 negative quarters of GDP growth in Q1 and Q2 of last year. This sparked this huge debate, right? And at first, Russ, we were on the side of the debate that said, hey, we don't think we're in a recession, okay? And the reason why is, listen, we get it. It's the rule of thumb is 2 negative quarters of GDP. But at the same time, I'm going to try and use this chart to explain why, you know, we continue to have like job gains and consumer spending continue to rise. You know, industrial production continued to go up. So all these other measures said, hey, we weren't in a recession. And I think, by the way, we ended up being right because, you know, Q3, Q4 of last year, GDP was positive, right? So overall, the economy did grow in 2022. So the reason why we were pretty adamant we weren't in a recession last year and why we're changing our opinion as we look into 2023 is this chart right here. I just call, you know, this chart is a chart about the shift in consumer spending preferences that happened during the pandemic, which, you know, it had to have been the fastest in US history that we saw consumer preferences change. And really, I mean, I say consumer preferences, but, you know, it really wasn't preferences, right? A lot of this was just by government mandate that, you know, you couldn't go on vacation or go to a restaurant or a bar or whatever. And so the services sector saw spending fall off a cliff. You can see that on the chart here, while the goods sector saw spending surge way above the long-term trend. And so I've got that, like the trend lines there, guys. So you can see, hey, if nothing, the pandemic didn't occur, like where would we be at? What would be normal? That's the point of the dotted lines. And so, hey, couldn't go to get a cocktail at your favorite bar, but you could stay at home and buy things off of Amazon. And so services fall, goods spending surges. Well, last year, we started to see a lot of layoffs in the goods sector. Spending on goods starts to fall, right? So, hey, you know, whether it was like Pepsi or Target or Amazon, there was no shortage of headlines showing big layoffs. But at the same time, overall employment continued to grow. And the reason why is, well, services were still recovering back to their long-term trend. And services are a bigger part of the economy than goods. And so amidst all of our problems, hey, the economy did grow in 2022. Well, the same reason we made the argument we weren't in a recession back then is why we're worried about a recession today. Because goods spending still has further to fall to get back to that dotted line. There's going to be more layoffs in the goods sector. We have to see that normalize more to get back to, you know, quote unquote normal. But the services sector has at this point basically fully recovered to where it would have been if COVID never happened. And so, you know, we can't rely on services to continue to bail out the overall economy anymore. And this is why I think you are going to see unemployment go up. You're going to see, you know, layoffs happen broadly across the economy. You're going to see, you know, economic growth contract in 2023. And this matters, guys, because, hey, we're getting relief on the interest rate side of things, but at the same time, corporate profits are probably going to fall in 2023 to some degree. And those two things right there, those are the biggest variables when we talk about financial asset valuations, interest rates and profits. Last year, interest rates went way up, but profits did pretty well. This year, I think we're going to see interest rates, you know, probably, you know, pause or even fall maybe a little bit, but profits are going to fall. And so overall, I think the market still has some bumps in the road that we have to deal with. So look out for an actual recession in 2023. And, you know, hey, once we get on the back end of that, I think, you know, we probably have a pretty good opportunity for a rally in the markets on a new bull market to form.
Bryce, what are the thoughts around this idea of a soft landing versus a hard landing?
Yeah, so I guess the case that I'm making right now, Mike, is that I think unemployment's going to go up. Now, you know, a soft landing ideally is unemployment doesn't go up at all, right? So I guess I really am kind of making the case we're going to have a hard landing, but I also don't want to oversell this to people, okay? Because, you know, and maybe this is just a figment of like the past two recessions we've gone through in the United States. First was the financial crisis, worse since the Great Depression. Then we had the COVID pandemic, which completely unprecedented what we just went through with regards to the economy. Normally, when you look from a historical perspective, recessions are not as damaging as we just went through with both of these, okay? I think we're in for a much, you know, more normal, I guess you would call it, recession from a historical perspective. Something that's a lot more, you know, easy to deal with than what the 08-09 financial crisis or COVID was, okay? So that's not what I'm calling for here. I'm not calling for the Great Depression or anything like that. I think really what I'm saying is we just need to see the economy normalize still from this pandemic stimulus that happened. And that's what I'm trying to communicate with these two lines here. Services are recovered, goods still has to fall through. And so a recession, but it's not going to be the end of the I guess that's the really the argument that I'm making here. So a hard landing, but it's not like a meteorite hitting the earth, right? It's a lot softer of a hard landing than that, I guess you would say.
Makes sense. Thanks.
Yep. So that's what I've got for prepared comments here, Mike. Guys, I'll put this up if you want to follow along with any of our commentary at First Trust. Everything we put out is free. It's available to you. It's all one page or less. It's easy to read, easy to share. I've got some ways to subscribe right there. You can see some examples of the pieces that we write on the left side of the screen. It's a good way to stay abreast of what's going on in the economy in a digestible way. I'm never going to send you guys like a 10-page paper on the yield curve. We write for normal people. So all the contact info is there, guys. With that, Mike, I think, sorry about that, guys. I'm going to go ahead and end my share screen here just so I can pull up those questions that you had sent over from the participants in my Outlook inbox. And we should just go through those and anything that I wasn't able to hit. Does that sound good?
That sounds perfect. Yeah, we've got a list of questions that were pre-submitted by our clients before the call today. And then if these maybe jog another question that comes up, like I said, feel free to hit that Q&A button at the bottom of your screen and enter a question, and we'll try to tackle that as well.
Okay, perfect. So let me just pull these up here. I had them ready to go. So, all right. So the first one we got here is: are there any investments that are under less adverse? Let's see what we got. Are there any investments that under less adverse economic times may be deemed too risky or uncertain, but today look like kind of a good opportunity, right? And so the first thing that kind of comes to my mind when I hear that question is commodities in general, right? And commodities have been one of the outperforming investments over the past couple of years. Like I mentioned, energy last year was like the only sector that was positive. That's because of higher oil and gas prices, right? And 2020 to 2022, commodities, just broadly speaking, everything from like oil and gas to copper to lithium to any of this stuff, it really outperformed. The reason why is, well, hey, in times of high inflation, commodities, along with things like small cap stocks or like value stocks, are historically what do very well because they're real assets, right? You're buying something physical in the real world. And so if the amount of money is expanding or inflation's high, real assets tend to outperform like financial assets, okay? And so I think that's kind of the environment we're in. The negative side of commodities is they're highly volatile. That's what they're known to be, right? So they're going to bounce around in price pretty rapidly. I would just say, hey, if you want to get into commodities, you want to buy commodities, you should buy a broad basket of them. Don't try to be the genius that knows exactly when oil prices are going to bottom or something like that. So buy a broad basket and diversify your risk a little bit. And then, if you're going to buy them, I would say hold them for a couple of years because, again, that volatility, you're looking at it from month to month. You're going to see a lot going on there. So that, just thinking about the current environment, things that people haven't liked previously that make sense today, commodities are like the number one thing that kind of comes to my head. So what will the next 12 months look like for individual families, groceries, travel, utilities, manufactured goods? So, I mean, this is a question on inflation, right? The cost of living has been going up. That's really, in most people's heads, that's what inflation is. Just like, how much does it cost me to, do what I was doing 2 years ago? And, on that front, I would say you have to break it down by different sections of the wage spectrum, because what's really interesting is in the United States, the past decade before COVID, we were having this big debate about income inequality, right? That's all our politics were about for a decade, right? And the reason why is, hey, most of the wage gains went to the top 10%, let's say, right? What we're seeing today is almost the opposite of that. If you're middle class, upper middle class, you have a fixed salary that you're on, okay? Hey, maybe you got a 5% raise last year, but at the same time, inflation went up 8 or 10%. So in real terms, your pay is bringing home less real goods and services than it was 2 years ago. So I think for a lot of those people, hey, inflation is going to take a bite out of your purchasing power. Now, at the same time, hey, middle class, upper middle class people, they have fixed rate mortgages. They have fixed rate car payments that are being eroded by inflation. So you're kind of getting some help there. You've got, savings. You probably have a brokerage account. Okay. So they're going to be able to kind of weather the storm. At the same time, though, the most vulnerable people, okay, let's say like the bottom 10%, people that are on like hourly wages, they've actually seen wages expand faster than inflation. So this is where I say, hey, it's like the opposite of 0809. And the easiest way to see this, guys, is go to like your local Chipotle. They're paying $20 an hour plus like fringe benefits, plus like 15 days of vacation and pet insurance and like everything else they can think of to try to get people in the door to work there. Wages have gone up much more than 8% or 10% for hourly employees. So obviously you want everybody's wages to go up more than inflation, but under the current situation, I think what we're seeing is basically income inequality has been kind of eroding here. So to the extent you cared about that the past 10 years, that's kind of the positive news. And for, quote unquote, normal people, that's usually who we're talking about, right? Who we're referring to, the most vulnerable people there. So they're actually doing okay amidst all of this. If you're kind of on hourly pay, that could change this year. Just being frank, we see unemployment go up. It's probably going to be those people that maybe get hit. But at least so far, where have all the layoffs been happening? It's like Twitter employees, right? Or, tech workers who are going to be okay, big picture. So next one is, what path do you see the dollar going through this year? What price level do you have the dollar at with your forecast? So guys, we don't forecast the dollar specifically. And like, this would be like the dollar index on Bloomberg is what this is referring to. So like the dollar versus other major currencies in the world. And 2022, I don't have the data specifically in front of me, but it's been one of the best years for the US dollar in decades, right? The dollar surged to a 20-year high. It did very, very well. If you're going to do like a European vacation or something, hey, 2022 was the time to do it, I guess. I don't expect that to continue in 2023. In fact, we've already seen the dollar fall a little bit. The reason why is, we had some of the tightest monetary policy, the highest interest rates in the world. That kind of made us look relatively better. That's going to probably change to some extent in 2023. We're going to either pause rates or cut rates while the Europeans are still hiking or the Japanese are still hiking interest rates. So look for the dollar to weaken a little bit, I would say, in 2023. But that being said, I don't think we're going back to where we were pre-pandemic yet. The dollar is going to stay, I think, at a higher level than pre-pandemic. The reason why for that is, I think that energy chart that I showed you guys, energy is kind of a unique good. It feeds the entire economy. We have probably in the United States have the most secure source of energy domestically of any other country. Aside from like, Saudi Arabia doesn't have to worry about energy, obviously. But, the United States is in a good position energy-wise. One of the reasons the dollar sold off so huge in the 1970s, it was the energy problem, right? And we don't have to deal with that today. So I think that's a huge advantage. Along with, hey, by the way, Great Lakes, we have the most fresh water of any country in the world. I guess, you could add Canada to that, right? They're bordered on those as well. And food. We're the largest food producer and exporter in the world as well. So the United States at like a base level, we're going to be okay here. We're going to be able to weather this better than a lot of other places around the world. Not saying we don't have problems, guys. That's really not what I'm trying to argue, but I think we do have some unique advantages here that are worth pointing out. So what's your assessment on what caused inflation? We kind of went over that, guys, but so let me just summarize it again. Too much money chasing too few goods. What happened during the pandemic? We printed $5 trillion. We shut down the entire global production system. That's how you get a 40-year high inflation. I really don't think we have to get more complicated than that. And some of these articles I read where people are going in and like breaking out individual components of like the CPI and writing a whole article about like used car prices or something. It's interesting. Like I, as an economist, enjoy reading into that. But for like a normal person, does that really help clear things up at all? I think you're just muddying the waters and making this more difficult to understand. We printed a lot of money and we shut down production. I mean, that's how you get a 40 higher in inflation, in my opinion, guys. Let's see. What else do we have here? Seems to me the Fed is aggressively trying to tamper inflation via demand impacting rate increases. However, without supply side changes, the Fed will wreck demand, cause economic pain, and then start reducing rates, which will lead to increased demand. Yeah, so this guy's, he's nailing it, right? The Fed, if you're looking for the Fed to completely solve inflation, and I guess I covered both sides of this, right? I talked about too much money and too few goods. The Fed can only affect demand or too much money, right? And they have done a reasonable job at controlling the growth of the money supply. So I will give them some props on that. But the point this guy is making in the question, he just absolutely nails it, is you can't solve the inflation problem without dealing with the too few goods side of the problem, right? And the only way that we get out of that is increasing our own production in the United States, becoming less reliant on some of these other places. Now that's occurring with things like semiconductors, and we are seeing a lot of reshoring occur, but it just takes years for that to get figured out, right? How long does it take to build a new manufacturing facility or like a refinery or whatever? And so, yes, the Fed cannot solve this by itself. And in fact, hey, sure, higher interest rates hurt demand, but they also hurt supply, right? And we're seeing this. I think the easiest example is like the housing market. Sure, like people are buying less homes because mortgage rates are way up, but we're also now building much fewer homes because, hey, developers don't see as much demand in the pipeline, right? So, yeah, the supply side of the equation, I think, is how we ultimately solve the predicament that we're in. How do we get out of the 1970s inflation? We mostly give Paul Volcker credit for this, but I honestly think like Jimmy Carter and Ronald Reagan deserve more credit. Jimmy Carter deregulated ocean shipping, railroads, airlines, trucking, energy. Ronald Reagan came in and did a bunch of boosted incentives for business and things like that. That's how we got out of the inflation in the 1970s. It wasn't just Paul Volcker, cranking interest rates to 20%. So yeah, I think we need to deal with the supply side of the problem. I think that question is absolutely spot on. And if we're just relying on the Fed, well, hey, yeah, maybe inflation moderates, the Fed kind of stops hiking rates, or unemployment goes up and they start to cut rates. Well, then we're just in for inflation to come spiking back, right? Because we're still not producing as much as we would have been. And by the way, that's what happened in the 1970s. Inflation kind of hit a peak. It started to fall, and the Fed reversed course, and immediately inflation spikes back up and hits a new high. I hope that is not the path that we're going on here, guys, but it's one reason to, again, take what's happening with just like the rate of CPI with a grain of salt. I don't think this problem's over. I think we have bigger issues with regards to the supply chain and globalization, everything else that we need to figure out. So that question is I can tell that guy has a good kind of finger on the pulse of what's going on. That's, we need to deal with the supply side of the problem for sure. Okay, last one is, hey, many economists are predicting the United States will likely tip into a mild recession in 2023. I talked about why I agree with that, guys. I do think we're in for a recession here. Again, it's just that shift in consumer preferences and normalizing back to like pre-pandemic trends. That's why I'm predicting a recession. Overall, I don't see like the banking system collapsing or some kind of massive black swan event. It's just we need the things to normalize, and they're still above trend in goods, and services have mostly recovered. So that's kind of the biggest reason why I continue to be, worried about a recession in 2023. So I do agree with kind of, I guess you'd call it the consensus of economists right now that we're in for, more bumps in the road in 2023. It's just a lot of it's, again, we're reaping what we sowed with these pandemic measures. So Mike, that's all the questions I have on this side of the screen. I don't know if we got any more in the Q&A box there.
We did, Bryce. So we got a comment regarding the supply side of inflation. And the question here says, given what we just said about the demand side, supply side inflation, so the real long-term solution to inflation is increased production domestically, ? But given that labor domestically is much more expensive than elsewhere, which makes sense, doesn't that then create more inflation? Or is that why the new inflation figure long-term could be somewhere between 3 and maybe 4%?
Yeah, no, I think that's exactly right. It's, part of it is the labor side of things, right? We just have less labor here, or more expensive labor here. I apologize. What I would say is, maybe I've kind of obviously I've talked about like reshoring, right, bringing production back to the United States. I'd say like one area you're going to see a lot of activity in is Mexico. Mexico is an obvious choice as kind of like a partner. We're already in, I guess we don't call it NAFTA anymore. We call it like the USMCA, but it's NAFTA, right? We're already in like a big trading relationship with Mexico and Canada. I see that set to expand, right? Maybe instead of producing things in China, we make some more stuff in Mexico instead. We just truck it right over the border, right? Or at least we're shortening supply chains in that sense. So there is kind of some ways around the more expensive labor, but yeah, generally speaking, it's a reason why I think longer term inflation, it's just going to be tough to get back to 2%. The labor supply situation is one of those components. One other benefit we have is immigration in the United States, right? People from all over the world want to come here. So that kind of helps on that side of things as well. But yeah, I think, more expensive labor is just, a fact of the day that we have to deal with. And, by the way, that kind of goes back to what I was saying with like income equality shrinking, right? Why did income inequality go up so much? Let's say since like the 1970s, part of it really was globalization, right? You have like a core managerial group of people or investors that build their production facility abroad. They use cheap labor, they import the goods, and then they mark them up. Well, you're capturing all the profits at like the top end of the income spectrum there instead of paying like hourly employees or whoever else. I think the negotiating power has kind of shifted back towards, working class type people here. So that, I mean, depending on, I guess, what side of capital or labor you're on, you could think that's a good or a bad thing. But I guess what I'm trying to communicate is that's like the mirror image of the decade after 08 and 09. So some kind of interesting changes happening there. And yeah, I think, the labor situation is a big component of it.
Touch on, if you would, let's go back to recession there for a moment, because First Trust thoughts are that we will see a recession this year. The argument last year was that you had 2 quarters of negative GDP, and technically that's a defined recession, but a lot of people came out and said, no, we haven't reached recession yet. So you all are calling for a recession this year, albeit mild. Maybe talk about leading lagging indicators. We've seen a lot of pain in the market last year. Was that a leading indicator to that? And maybe speak to that a little bit, because I know everyone's dying to hear, what does that mean for the market? If there is a recession coming this year, what does that mean?
Yeah, so I think, yes, we had pain in the market last year, but, by the way, the past like 3 months, the market was either flat or like rebounding, right? So I think actually what we saw through the end of 2022 was a higher kind of, confidence that maybe we could pull off the soft landing, right? And, by the way, we have pretty strong labor market figures, so I'm not, writing that off entirely. But as far as leading indicators go, I think a lot of them have started to sour. Labor market, you have to dig under the surface, but there is some kind of more weakness showing up there, some cracks there showing up. But other measures that we tend to look at, like retail sales or personal income adjusted for inflation, or industrial production has slowed to a crawl. Heavy truck sales. I don't know what it is, guys, but these semi-truck drivers, at least the companies, they always know when a recession's coming. They start pulling back on the purchases of big rigs. Those have started to fall. ISM manufacturing, you go out and you survey all these purchasing manufacturers or the purchasing managers in the manufacturing industry. We're in contraction territory from a sentiment perspective there. And now, just as of last week, everybody was kind of celebrating this latest jobs report, where we saw jobs go up like 230,000. On its face, pretty good. Now, under the surface, hey, hours worked actually fell, so maybe it's not as strong as it looks. I actually didn't even think that was the most important report of last week. It was the ISM services report. Services, again, have propped up the overall economy in 2022. What we saw last week on Friday was ISM services went into contraction territory for the first time since, briefly it did during the height of the COVID days, right, for obvious reasons. But for the first time really since like 08, 09. So the services sector, I just think is starting to scream, hey, we're running out of gas. We can't keep bailing out the overall economy. So yeah, some of these indicators have started to get a little bit weaker for sure.
Bryce, if you don't mind, make maybe some comments on portfolio positioning going into this year. There's a case to be made for indexing with the S&P 500 and other major indices that are out there. There's a case to be made for active as well. And there's also a case to be made is 60-40 no longer broke. The old acronym last year, or for many years, we've heard as TINA, right? There is no alternative to stocks. the one being tossed around now is Terra. There are reasonable alternatives to stocks as well. So maybe you can talk a little bit about that if you don't mind.
Yeah, absolutely. So, I think the biggest thing, guys, is there's going to be more bumps along the road here. The market's going to continue to be volatile. I'm not a genius trader. I think the easiest way to weather all of this is just get more defensive in your positions, right? Don't be betting on, high growth stocks or companies with few earnings. Look for cash flow, look for earnings today, lower multiples, things that are safer like consumer defensive, consumer staples. People are still going to go out and buy toothpaste and things like that, right? Defense stocks. We've seen defense budgets all over the world rising, potentially adding member states to NATO. That stuff makes sense to me. But yeah, I think, the 10 years after 0809, what was it? You just throw a dart at a board and you make money. And then we got to be a lot more tactical now. Get defensive, try to preserve your capital as we make it through this volatile period. Once we get on the other end of it, hey, there's going to be another bull market eventually. I think for most people, there isn't, if you have a long time horizon, if your time horizon is longer than like 3 or 5 years, overall, maybe you shouldn't change a ton about what you're doing. Stay kind of long-term focused. But overall, it's about preserving capital. I think the days of just like 20% returns, they're over for the moment.
And that's very helpful to know. We often hear or often say, and our clients know this, so we often say we invest for decades. So we're always looking very long-term on there and not trying to make any rapid moves. But I completely agree with you on the high growth. Obviously, the wind is not behind the sails of high growth and momentum trades right now. The strong cash flow, strong balance sheet style companies make a lot of sense. What about fixed income? Obviously, fixed income got hit pretty hard last year. Some would say that was a reset, that now you can buy bonds below par and get a pretty decent coupon to weather any kind of downturn in the market as well.
Yeah, I mean, hey, you could buy a 10-year treasury at like 3.5% or like 4%. That's like pretty solid right there, right? If you're going to hold it to maturity, that's not bad. You're probably going to do okay. I'm not, I don't know how well you're going to be able to trade fixed income, but even like short maturity stuff, there's like 5% yields on short-term treasuries right now. So there's definitely alternatives to stocks again. I would also say there's alternatives to stocks and bonds. Something that the financial industry has really done a good job of over the past, let's say, 5 years, is providing more and more access to some of these private market things like, private equity or REITs or, access to commodities or plenty of different alternative strategies that have a pretty low correlation to the broader public markets. So that's another place to look, right? It's just like another kind of arrow in the quiver that really hasn't been available to most people for the past and is kind of today.
We're big believers, as many of our clients know, in non-correlated asset classes or low correlated asset classes like private equity, private debt, private real estate, et cetera, which brings up a good point. Obviously, public real estate had some negative consequences this past year. Some may think that is kind of a little bit of a leading indicator for private real estate to feel that effect as well. Just some general thoughts that you have on real estate, if you don't mind.
Yeah, I think, we saw private real estate like residential REITs do really well during 2021 because, hey, the lockdowns ended, people started moving back to the cities and, they were able to raise the rent like 20% year over year. I don't think that that's going to continue to happen. We're already seeing, signs that rental rates are slowing down much, pretty rapidly here. If the labor market eventually weakens, yeah, the pricing power of these apartment buildings is going to be a lot less. And just my opinion, guys, I just look at the data, and you can go look at this as well. I think it's the Census Bureau that keeps track of this, is just the number of units, like apartment buildings under construction in the United States, is currently at a record high. So even once we get on the other end of the recession, what everybody did during the pandemic was start building apartment buildings everywhere because housing got so expensive. I think there's going to be a lot of units coming online that's going to really hurt the pricing power of some of these residential real estate investment trusts. So everybody still needs a place to live, right? I mean, these are going to be fine as far as assets go. If you're holding them for like the long term, they're good things to own. But I'm just saying, like, the days of like 20%, 30% returns on residential REITs, I think that's going to be gone for the foreseeable future. I think we just saw the big opportunity over the past couple of years. that glut of inventory coming online, it's going to have big implications for pricing power in that industry.
That's very helpful to know. Yeah, very interesting market that's taking place in real estate right now, particularly the shift that we saw away from office and retail and more to multifamily and distribution centers and areas like that as well. I'll end with one last question. As you look at the economy, both domestically and macro level from a global perspective as well, what's one thing that keeps you up at night?
Yeah, I mean, the biggest thing is just deglobalization, guys. I hate to keep harping on it, but really, I mean, we haven't seen globalization fall for the United States for like 100 years. So everybody alive in the public financial markets that works in this industry, that's something that's just been a given for a long time, right? A lot of the market returns that we've seen for forever have been based on this kind of trend going on in the background. If that becomes less reliable, or geopolitics continues to get hotter and hotter, that's another thing we haven't had to worry about as investors for my entire career, right? The Berlin Wall collapses, the Soviet Union goes away. There's been no geopolitical risk really at all for the past 30, 40 years, right? Obviously, we have like 9/11 happen, and I'm not saying there hasn't been big issues that occurred, but those didn't really affect the ability of ships to sail from one port to the other, right? Some of this stuff is changing in a pretty significant way. The implications of it are so massive, it's hard for me to even really wrestle with them all. But I think some of the status quo that we've all gotten used to, it's just not so reliable anymore. And so the deglobalization side of things, I think, is one of the most interesting changes that's going to be staying with us from this COVID pandemic.
That's a very interesting perspective and something that I would bargain most people have not given much thought to on the deglobalization side of things as well. I'll give it 30 seconds just if anyone wants to post a question. Looks like we had one just pop up as well, and then we'll go ahead and wrap up here shortly. One of the comments here, the gentleman that just asked the last question, one of the comments was, "Many thanks to Bryce for putting this in plain English for the rest of us." So, Bryce, I will echo that.
Yeah, if I can do that, I mean, I feel like I did my job well today. So thank you guys so much for having me. Really appreciate all the great questions too.
Bryce, we really appreciate you being here today. Happy New Year to you and your family, and thank you for your partnership as well. First Trust is a great partner of ours. And to all of our attendees and clients today, thank you very much for taking the time out today on a Monday morning at 11 a.m. on the Eastern Coast. We will be recording this and actually posting this to our YouTube channel as well. So thank you all for attending today, and those that didn't get to see this, I hope you enjoyed this as well. If you have any questions after this message, and I apologize, looks like another question popped up here as well. Oh, not a question, just a comment. If you had any questions that we didn't get to today or something, just a burning question after this as well, feel free to reach out and email us, and we will do our best to get an answer to you as quick as possible, and we'll reach out to Bryce with those as well. But on behalf of the Legacy team and all of our partners here, we really appreciate you taking time today to be here. And Bryce, thank you again.
Yep, absolutely. Thank you so much for having me, Mike. Everybody have a good one.
Thanks, everyone. Take care.